Let's jump right into this explainer. Today, we're tackling something absolutely crucial from Module 2.1 of the FinLit Zambia curriculum, escaping the inflation trap. I'm going to show you the exact, hidden mathematical reason why your traditional savings might actually be losing value right under your nose, and, more importantly, how you can fix it. Let's get started.
Okay, I want you to think about a very specific number, K 4,512. Just let that sit in your mind for a second. Now, this isn't some hidden bank fee, and it's definitely not a tax. This is the exact amount of purchasing power that a 26-year-old accountant named Ninkamunya lost over a 5-year period. And you know what the truly wild part is? She didn't lose this money by making some reckless gamble or a bad impulse buy. Nope. She lost it by doing exactly what most of us are taught is the responsible thing to do. She left 10,000 kwacha sitting quietly in a standard savings account earning a 3% return. Let's break down exactly how this happened.
So, here is the mathematical reality of what we call the inflation trap. It's kind of like a giant puzzle where the pieces keep changing size. Njomia started with 10,000 kwacha. She kept it safe in the bank for 5 years, getting that 3% interest rate. And, well, her money did grow. At the end of those 5 years, she had 11,593 kwacha. On paper, she was richer. But here is the massive catch. Over that exact same 5-year period, inflation here in Zambia was averaging around 10% per year. That means the cost of everyday goods was rising way, way faster than her savings. What cost 10,000 kwacha 5 years ago suddenly cost 16,105 kwacha. So, she had her 11,593 kwacha, but she needed 16,105 kwacha just to buy the exact same things. She was short by 4,512 kwacha. She didn't spend it, she just saved it in the wrong place. Her money grew, but prices grew a whole lot faster.
So I have to ask you, are your savings secretly bleeding value right now? Are you falling into this exact same trap? We usually think of thieves as, people who break into our homes. But inflation? Inflation is the silent villain literally stealing your future wealth. If your cash is sitting in an account earning maybe 3 to 8% a year, but the inflation rate is hovering at 10, 11, or 12%, your real return is actually negative. You are safely, predictably losing purchasing power every single day. Recognizing this invisible drain is absolute step one toward true financial independence. To escape this trap, we absolutely have to understand the fundamental difference between saving and investing. They are not the same thing. Saving is all about keeping your money safe. It's highly liquid, meaning you can grab your cash immediately if you need it, but it typically only offers a 3 to 8% return. That leaves it incredibly vulnerable to inflation. It's meant for your emergency fund, not for building your future wealth. Investing, on the other hand, makes your money grow. Yes, it absolutely involves taking on some calculated risk, but it is literally the only mechanism designed to outpace inflation and build long-term equity.
So the crucial point here is understanding the golden rule that governs this whole system, the risk-return spectrum. This is the absolute bedrock of capital markets and really a core concept in the FinLit curriculum. Simply put, it's the financial principle that your potential return rises with an increase in risk. It's a trade-off. If you want the absolute highest level of safety, like that standard bank account, you just have to accept the lowest possible return. But if you actually want to grow your money and beat inflation, you've got to trade a little bit of that absolute safety for the opportunity to generate a much higher yield. Now, you don't have to be reckless, for sure, but you do have to step out of that pure safety zone.
Let's look at how this plays out across actual Zambian financial products for 2025. You can see a clear progression up the risk-return spectrum. On the ultra-safe end, you've got your standard savings account, giving you roughly 3 to 8%. Then, moving up just a bit, taking on just a tiny fraction more risk, we have government treasury bills, or T-bills. A 91-day T-bill yields approximately 11.5%. You're basically just lending money to the Zambian government for a few months. Then, if you're willing to lock your money away for longer, we have 10-year government bonds yielding around 16.6%. And these are verified 2025 market rates. By simply moving your capital from a basic savings account to a government bond, you've massively increased your ability to outpace inflation.
Now, there's this massive misconception floating around that you need to be wealthy to access these higher-yielding assets. But let's look at the actual minimum thresholds because it totally demystifies the whole thing. If you want to buy those 91-day treasury bills we just talked about, the minimum non-competitive bid is just 1 kwacha, literally K1. What about a money market fund where professionals pool and manage the funds to return 10 to 14%? The minimum is typically between K500 and K1000. And for those high-yielding government bonds, the minimum entry is K5000. Investing is definitely not locked behind some VIP wall for the wealthy. The barrier to entry in Zambia is actually incredibly low. And that brings us to the real engine of wealth building, the Lusaka Securities Exchange, or the LuSE. Established back in 1994, this is Zambia's actual stock exchange. As of 2025, the LuSE boasts a total market capitalization of over 276 billion kwacha. This is where we hit the medium to high risk end of our spectrum. When you invest here, you aren't just earning interest on a loan. You're buying actual ownership shares in some of the largest, most profitable companies operating in Zambia today. It usually requires a 5+ year timeline, but historically, this is where massive capital growth actually happens.
Think about some of the major players listed on the LuSE right now. We've got Zambeef Products plc, the largest cold chain food provider. We have Zanacor, one of the biggest financial services providers by market cap. We've got ZCCM Investment Holdings plc, giving you direct exposure to Zambian mining interests. And the beautiful thing is, there's no fixed minimum to start investing here either. It completely depends on the share price. You can literally buy shares in these companies for just a few kwacha each. You can transition from being just a consumer of Zambeef or just a customer of Zanacor to actually owning a piece of the business and sharing in their profits through dividends. That is a real game changer.
So how do you actually do it? Well, it's remarkably simple, and it breaks down into 4 really practical steps. Step 1. Contact a stockbroker licensed by the SEC and the LuSE, folks like Pangea Securities or Madison Asset Management. Step 2. Open an account. All you need to bring is your NRC, proof of address, and your initial funds. Step 3. Place your order. Just tell your broker which shares you want and what price you're willing to pay. And finally, Step 4. Settlement. Your trade settles in 3 business days, and those shares are held securely, electronically, in your name. That's the whole shebang. In 4 easy steps, you can completely change your financial trajectory.
We've covered some incredibly powerful ground today in this explainer, from the silent drain of the inflation trap to the empowering mechanics of the LuSE. So, I want to leave you with a final, provocative thought. In finance, there's a concept called opportunity cost. It's essentially what you give up by choosing one path over another. If you leave your hard-earned wealth sitting in a 3% account while inflation rages at 10%, what is your true opportunity cost? What future wealth are you giving up by avoiding the calculated risks of the financial markets? Calculate your own numbers, take that first actionable step, and start putting your kwacha to work. Thanks for learning with me today.